Good morning, everybody. Hope we're doing really good today. Everybody likes dividends. Well, maybe not everybody, but I like dividends, and you probably like dividends too. And dividends, they're usually paid out quarterly. Paid out 4 times a year, but that really isn't fun. It isn't fun to get paid out 4 times a year. Some people want to get paid out more often than that. Get paid out monthly. And some people, they need the income now. So that's why they like to get paid out monthly. They're retired or there's some sort of situation where they need the money now. Or maybe you just like the feeling of getting paid more often. So either way we look at it, getting paid monthly or getting paid more often is a thing that investors want from their investing goals. And in this video, we're going to talk about 4 monthly paying dividend ETFs. If you're new to the channel, I'm Justin. I like to talk about dividend investing, income from option, financial independence, and anything else, money related. So if you like money, you should probably subscribe to this channel if you haven't already. One thing I think is important with income investing and dividend investing is still price appreciation, total returns. Because it doesn't make sense to me that you would invest in some sort of ETF or a stock or something and get paid in a bunch of yield, but then the price appreciation, or the price actually doesn't appreciate, it depreciates, price goes down. But you have this big yield, but the price goes down, so you're kind of breaking even there. And I don't think that's a great way to build wealth. Not even really sure it's a way to maintain wealth. So all of these have some sort of price appreciation in them. There's some ETFs that pay out a lot of dividends, pay out a lot of income, but they don't have any price appreciation and they're not really stable. Except for the last one. The last ETF on this list is a little different, so stay until the end and watch that, and you'll see what I'm talking about. First ETF on our list is the Invesco High Yield Equity Dividend Achievers ETF. This ETF is based off the Dividend Achievers Index, which is companies that have increased their dividends for at least 10 years. And then they take the top 50 yielding companies from that index to create this dividend ETF. And it's called the Dividends Achievers 50 Index. Right now it's trading at about $21 and it has a yield of 3.5%, but it does have a high expense ratio of 0.52%. This is the most expensive ETF on our list. It has an inception date of December 2004, so it's also the oldest ETF on our list. It has 52 holdings in there, and the top 10, you see One Oak is number 1 at about 4% of the fund, and One Oak is a natural gas pipeline company. You have Altria, AT&T. AT&T will be cutting its dividend soon. ExxonMobil, PPL Group, and nothing too interesting there. Just usual names that we see on when it comes to dividends, high yielding companies. Its past 10 years of returns, it's averaged about 13.75% a year, and the ticker PEW. Next on the list is the WisdomTree US High Dividend Fund, ticker DHS. This is an index that WisdomTree put together. Currently trading at about $80. Its yield is similar to PEW. Its yield is about 3.56%, and the expense ratio is a little less with 0.38%. And since this is an index, the names are a lot more common than on the PEW ETF. So top 10, we have Altria, Philip Morris, AbbVie, AT&T, Verizon, Pfizer. Same companies that you would think would be in a dividend paying ETF. This is a little newer and this was created in 2006. And since inception, it has returned about 6.8%. But for the past 10 years, it's averaged about 10.4% on average. When we compare DHS, the WisdomTree ETF, the PEW, the Invesco ETF, we can compare them since inception of DHS. And since then, DHS has outperformed PEW a little bit over the past, since 2006. But on the 10 years, the PEW outperforms. Next we have SPHD, the Invesco S&P 500 High Dividend Low Volatility Portfolio ETF. This one's a lot more common. You see this a lot more on YouTube, with a lot of YouTubers talking about this and recommending this for monthly dividends. It is cheaper than the other two. This one has a lower expense ratio of 0.3% and even higher yield of 0.37%. And its top 10 holdings are a little bit different as well. Like number 1, we have Iron Mountain, a REIT. And then number 2, we have Lumen Technologies. Number 3 is ExxonMobil. Number 4 is Kinder Morgan. And we go down to number 10 is AT&T. So it's a little different than the others. And I think it has about 52 holdings in all. Now it's not been around for 10 years, but since inception in 2012, its average return is about 11%, and 5-year average return is about 8.6%. Comparing SPHD to PEW and DHS, since inception of this ETF of SPHD, PEW outperforms all of them, and SPHD comes in second, and then DHS comes in third. These returns here are just price appreciation. The dividends are pretty much the same. There's a little difference in, there'll be a little bit of performance because the most expensive ETFs also have the lowest yield. And the highest yielding ETF, SPHD, has the lowest expense ratio. So there's going to be some extra wind in the sails of SPHD. Now, the fourth company on our list is a preferred shares ETF. Now, preferred shares are a little different than common stock because if you think of bankruptcy protection and stuff, you have, bondholders, they're up here, and then you have preferred shares down here, and then you have the common shares down here. So they're in between there, according to bankruptcy and contract law. One thing with preferred shares, they're not going to have much price appreciation or much price movement at all, but they will have higher yields. They're not going to increase the dividend regularly like you do on common stocks, but you are legally obligated to your dividends if you own the preferred shares. If for any reason a company has to cut its dividend on its preferred shares, you are still owed those dividends. And when it can pay back, the company will reimburse you all your missing dividends that you earned when you're holding those preferred shares. Where with common stock, there's no guarantee at all to the dividend. They can cut that whenever they want. Now the ETF is the Global X US Preferred ETF, an index approach of preferred shares. Currently trades about $25, and it always kind of trades about $25. And this also has the lowest expense ratio of 0.23%, which is really good, and then the highest dividend yield of 5.07%. But it's also the newest ETF. This is only about 4 years old. Inception date of September 2017. You can see from its price history since inception, it just hangs around there about $25 or so. And even in the COVID correction in 2020, it only fell a little bit to $22. So there you go. You got 3 monthly dividend paying ETFs that are relatively different from each other, that you can choose what you think is the best, and then a preferred shares dividend paying ETF, which will be a lot stabler and a high yield. So I hope you get something out of this and something to look at. If you need monthly income, go ahead, give me a like if you appreciate this video, if you learn anything. Subscribe to the channel if you haven't. Then I want you to go have a good day, all right? Justin out.